so there's a lot inside these regulations, and perhaps you tag in bits of EMIR on this as well, that puts in product fragmentation, separating derivatives from cash, payments from investments, netted sets that have always allowed a more efficient use of collateral. Now you have the cleared piece, the uncleared piece, the derivative versus the delivered piece, all going through different trading systems and different post-trade systems, which is just very inefficient, and it will end up with one thing, which is putting up cost to net users. There's also fragmentation versus reference data, the idea that you can get a common price set, and we think that the OTC market, using the new LEI and USI reporting mandate that's being pushed globally, can actually produce common tapes from having competing venues very, very easily if the venue so wished. But again, Europe needs to understand it's got a whole bunch of silos that operate with a with-profit model. One of our big issues is an issue around match principal broking, where our members operate the fixed income markets, i.e. cash bonds and sovereign bonds, by a match principal model, instead of using their own name instead of the direct names of the intermediaries. This is something which, again, a huge amount of political fight going on at the moment in Council and Parliament, and we just say, look, this allows you to have a corporate bond market and sovereign bond market not restricted to the 2 or the 3 on-their-own issues. It allows these markets to work, which would otherwise, they wouldn't even move abroad, they'd just close down. Why, when banks are stopping lending, do you want to do this? Why, in the name of having a system that stops match principal broking? We haven't had a coherent argument other than it doesn't fit into the neat sort of equity-driven framework that they want to import. And again, we're fighting very hard to allow that match principal broking to thrive, because corporates and sovereigns are going to need to issue more bonds. Why not have a system that works for them? Commodity markets, MiFID tries to do a bunch of stuff there. It tries to put in position limits, and it asks the venues to look at position limits. Well, our members, they match and find liquidity. They don't know the positions of the people trading with them, let alone the positions of their clients. So we don't know how much oil BP's got, and in fact, in the ground, it's got quite a lot. It's got a lot in tankers. We don't know what they are. We can't monitor that or enforce it. MiFID is asking us to do it. It's utterly impossible and utterly mad, and quite how it's got, into the parliamentary text and is progressing as it is in the council text is beyond us. And there is a concept there that is in commodity markets: is shoot the messenger. Don't organise supply and demand when the prices go wrong. Just stop the market from trading, and then that's fine. And as I say, if you want to regulate volumes rather than price, you'll end up with a rationed market rather than availability. Again, it doesn't serve consumers very well. Just points 9 and 10. I know that I've overrun. 9 is extraterritoriality. The wholesale markets are very global in scope. You should regulate at a wholesale level. If you regulate the participants and not the product, you have relatively few participants in the world. Maybe 50 participants rather than 50 million products, and those participants are operating in Japan, in South America, in America. Very much easier to regulate them in terms of conduct than it is in terms of all of these products by a whole lot of regulations. It seems to us a strange way to approach it, given that it has always been based on conduct of business rules, and again we would advocate that as a simple starter to extraterritoriality with a passporting regime that allows European consumers to access the financial investments around the world, and the rest of the world to give their commodities and other products into the European market as well. And just my 10th point is really the future, which is everything's changing so much. The changing nature of the availability of capital means that banks and all the banks, and you see it every day. You saw it yesterday with Citibank, last week was Credit Suisse, the week before UBS, are laying off a lot of people, and they're turning the cost of their balance sheet is getting very, very expensive under Basel. So it is changing the nature of markets. Banks are acting as agents. And all of these platforms are very important now, because they're going to be the way that banks act as agent and introduce third parties without actually being the dealer principal to all of these trades. And this is a very different way to which we've seen markets work really since, I guess, the big bang of the early 1980s. And given that massive change, I think it's difficult to make those platforms too prescriptive and to make them too expensive, or else you're just increasing costs to end users. And again, a lot of the issues around MiFID make the barriers to entry very, very expensive. The compliance issues, the technology issues, the capital issues, very expensive to get there. You've got to connect to all of these different clearing houses, et cetera, et cetera, et cetera. Barriers to entry get a lot higher, competition goes down, net benefit to the consumer goes down rather than up. MiFID 2 becomes the opposite of MiFID 1. You want to allow more innovation, more Schumpeter, more competition, And just lastly, HFT, not an issue in wholesale markets. It really doesn't happen off exchange. But algorithmic trading, particularly when the counterparties don't have the capital base to quote you or quote you very expensively, execution becomes algorithmically led, i.e. you execute slowly versus algorithms, and the separation of algorithmic trading, which is an execution method of disintermediation, which is very different to HFT, needs to be taken into account in all of these days of putting in regulation of HFT. And that's my 10 points. Thank you.